Oh boy, do we have an AMC update for you guys here today. A lot of things happening in the markets today. Another big catalyst that we're going to talk about starting at about 1 p.m. today. Ladies and gentlemen, let's get into all of this information. AMC's cost to borrow fees are rocketing higher here today, but that's not really the big story. The big story of the day today is that the S&P 500 is approaching that 430 level. And you hit a high of 429.46. Mike Wilson says this is a hated rally on Wall Street. We're going to dive into this article as well. It says Morgan Stanley sees an earnings wipeout ahead for Wall Street's unloved stock rally. But first, before we get into that, what is causing the markets to be bullish today? Even AMC stock is up about 2% at the time of recording this video. Well, it's ISM Services PMI for the month of May. So the overall number was expected to come in at 52.2. It came in at 50.3. So bad economic data. This is terrible for people that are fearing a recession. This is like saying, hey, a recession is more likely now than it was yesterday. But that's good news for the Fed. That's good news for inflation. And basically across the board, it was a miss. Factory orders month over month came in at 0.4. You were expecting a 0.8% increase. ISM services employment came in at 49.2. You were expecting 50.8. ISM new orders came in at 52.9. You were expecting 56.2. ISM service prices came in at 56.2. You were expecting 59.7. ISM services business activity came in at 51.5. You were expecting 52.1. And then factory orders ex transportation came in at -2. You were expecting -9. So across the board, positive news on inflation, very bad economic data. So closer to a recession, but closer to getting, hopefully, I mean, this is how the markets are taking it, the Fed to pause their interest rate hikes and then to subsequently start to cut 3 months after that. That's historically what tends to happen. So this is really causing your big tech stocks to really lead the way higher again. The NASDAQ is up 0.5%. The Russell 2000 is down 1.26%. The VIX is up 2.26% right now. And breaking news, Mike Pence files paperwork to launch 2024 Republican presidential campaign. What a weird day. Michael Pence wants to be the president. We'll see what happens there. But let's talk about this Morgan Stanley piece. And they say that earnings are likely to get wiped out. Now, if we look at exactly what he says, it says, that brings our call of the day, and let the tomatoes fly as our favorite bear is back. Morgan Stanley's, quote, worried Mike Wilson, who still expects a meaningful earnings recession this year, down 16% year-over-year decline that has yet to be priced in by stock markets. While his S&P 500 base case remains unchanged at 3,900, the lower end of street forecasts, the strategist says investors are stuck in the middle of several hotter but shorter earnings cycles in the context of a broader secular bull market. Boom, bust, boom, the strategist said in a Sunday note. Wilson says the bank expectations for a bigger stock drop have been kept at bay by the outperformance of AI players and some big tech names, Fed pivot fever, and hopes we've been through the worst of an earnings recession. But a major repricing has hit lower quality, cyclical, and small cap stocks, he added. The strategist offers some guidance on when the market will finally start pricing in that earnings route. Focus on the equity risk premium portion of the price to earnings PE ratio. The ERP is defined as the difference between the expected earnings yield and the yield on safe treasuries, with a higher number meaning investors are being compensated more for putting money in stocks. He said more than 100% of the reset on PE last year was due to higher 10-year treasury yields. Historically, that moment of recognition for the market typically occurs when the forward NTM, next 12 months, EPS forecast for the S&P 500 goes negative on a year-over-year basis. The expected liquidity drain from the debt ceiling passage may help push this process along, he said. And basically what that is, it is the funding of the TGA. You're actually seeing today your first bond auctions since the debt ceiling has been raised. This is an effort to raise capital. You're seeing in between $30 and $60 billion being raised on the 3-month and the 6-month bonds here today. It doesn't look like we have a interest rate on that yet. We can go ahead and check and see if we do. But so far, let's see. Okay, so yields actually dropped a little bit. The 3-month bond auction came in at 5.22%. 6-month bond auction came in at 5.25%. Still pretty high. And based off of what markets are expecting, the way that they're pricing, I mean, you're expecting the Fed to start cutting rates pretty soon. And the bond yields are still 6 months out, expecting a 5.25% interest rate. So they're raising billions of dollars. Some people say this is equivalent to the Fed raising rates again. Some people say it's equivalent to 2 rate hikes. You're expecting about $1.4 trillion of bonds to be dumped on this market that will take capital out of stocks. It'll take capital out of basically everywhere, right? As people need to buy up these treasuries. So that's another developing story that we will be watching very closely. Now, as far as AMC and GME, well, we're really waiting for GME earnings. GME is up almost 4% here today. AMC stock is up 1.43%. You're still in this bottoming process. It's been a steady kind of ride here because of the option activity that you have been seeing. Those deep in the money puts continue to take their toll on AMC, and you're seeing it yet again today. More so concentrated at the $5 put, though, still in the money. But I mean, it's not the $10 puts. It's not the $1 million trades so far that are coming through for AMC. And that's kind of when you've gotten these green days, is when there's less of those synthetic short positions that are coming out. Today, you have seen 5 orders totaling $560.31 thousand. Positive order value of 0%. So not good, right, to say the least. And it is, contributing to kind of keeping AMC stock tame. Now, if we look at an overview of the short interest on AMC, you are looking at a short score of 92. This number keeps going higher because days to cover is also going higher. Days to cover is now at 7.47. 3 months ago, it was at 5.29. So the days to cover is going up quite a bit, basically showing you there is low volume and low kind of trading activity in AMC. Well, there also is still massive short positions on the stock. So what this means is if you do see a catalyst or a reason or something to cause AMC stock to move higher, well, you're probably going to see a hard time for shorts to get out of short positions, and that can drive up the stock more rather than not, because if there's just not a lot of shares available, they have to start paying more to get more shares to cover on their short positions. Now, $507.64 million currently is sold short in AMC stock. Estimated short interest on free float at 21.61%. Free float on and loan at 35.4%. Shares on and loan 182.8 million. Days to cover 7.47. Cost to borrow at about 59%. And you do have 100% share utilization. Now, if we take a look at the cost to borrow fees today, cost to borrow max is jumping to 126.36%. I find this interesting that cost to borrow fees are moving up heading into GME earnings, kind of showing a little bit of that risk to hedge funds starting to be a little bit more priced into the borrow fees. Kind of the shorting is starting to get a little bit more expensive heading into GME earnings. Now, live short interest on free float at 21.72%. As you guys do know, the short interest is really around 35% because you do have a lot of those synthetic short positions on AMC stock from hedge funds that have bought those deep in the money puts that have forced market makers to short tens of millions of shares of AMC. Now, cost to borrow average sitting at 73.2%, cost to borrow minimum at 50.13%. Interactive Brokers short availability has about 150,000 shares currently available with a 64.66% cost to borrow fee. Now, the big catalyst really of today, forget the ISM services PMI. That's big, and I think that was very bullish for the markets. Not so bullish in the long term, not so bullish in terms of a recession. Looks like a recession's more likely again today than it looked yesterday. But the big catalyst of the day today is actually Apple's event. Now, Apple's WWDC 23 is going to be happening at 1 p.m. today, 1 p.m. Eastern, 10 a.m. Pacific. And you're expecting a release of the kind of like Meta's Oculus. You're expecting Apple's headset. Now, I personally think, considering Apple is at $184.22, you've priced any good news into the stock. Apple is almost a $3 trillion company now. All the good news is priced in. So unless they come out with something absolutely crazy that we don't see coming that could add billions and billions and multi-billions of revenue to their business relatively soon, you're probably not going to get a bullish reaction in Apple itself. And you might start to see big tech actually roll over. And that could potentially be a big catalyst for the day today. So there you have that. If we take a look at AMC stock, you are in this bottoming process, like I said, ever since you did hit the low and you wicked down here, found some solid demand around $4.37 per share. You have started this upward climb, and you did rally after May 31st. You did go up 1.11%. You were flat the next day, and now you're up 1.65%. So it's been very slow, and I think the ultimate catalyst of this week is obviously going to be GME earnings. GME earnings expectations are really causing the stock to break out here. GME is at $25.60 per share, higher than you have been in a very long time. And bottom line, if GME comes in with some profits here, well, the stock's going much higher. You're going to get a short squeeze, likely in AMC as well as obviously GME. The meme stock rally could come back very quickly. And really, with both of these names, AMC and GME, they're heavily shorted. GME's days to cover is higher. Legal short interest is roughly the same as AMC. GME's volume just overall has been very low. There's a lot of bullish positioning in GME from hedge funds, and GME just had a last quarter of profit. So if they have another quarter of profits, well, that's showing more than just a one-off quarter of profits. That's showing maybe a trend to stay in profitability. Now, AMC stock, roughly the same short interest as GME. Lower days to cover. GME's days to cover is like 16. AMC's is 7, almost 7.5. So still, both of them are very high. But AMC has tens of millions of shares shorted by market makers, and I think that is a big difference between these two names that could help AMC kind of match GME's earnings move more or less. If there is an upside move, I think those market makers covering on short positions, tens of millions of shares potentially. If GME does rally, 50%, AMC could rally 25+% based off of that. You might get a stronger correlation with GME and AMC this time around because of a lot of these market maker shorts that are currently on AMC stock. And it looks like AMC has priced in a lot of bad news recently. I mean, the stock's been basically going down for the last month and a half now pretty consistently. So it looks like bad news is priced in, good news not so priced in. Ladies and gentlemen, that is going to do it here in this video. Hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. You guys have a great rest of your day, and I will see you in the next one.